welcome to our Rethinking Reinsurance Renewals webinar. My name is Nick Hill. I work with Prince Communications, a boutique insurance PR firm, and I'm going to help guide you through this enlightening session today. The background, as you guys all know better than me, we've all had the cat treaties have been renewed, and there's been a lot of good savings that people have had along the way, and really sort of wanted to have a look about what other options we have for maybe optimizing our reinsurance programs a little bit better. From what we're seeing in the market, we haven't really seen reinsurers coming down the tower too much. Where there are structured programs, they're not really looking at maybe some of the ground up challenges that a lot of people face from a severe convective storm and secondary perils perspective. So we'll dig into that a little bit with the three panelists that I've got with me today. So we've got Jake Black, who's the president and CEO of Midwest Mutual, CFM Insurance, and the new Ember Mutuals. Hi, Jake.
Hey, Nick.
And
Thanks.
we've got Joe Petrelli, who's the founder and CEO of specialist rating agency Demotech. Hi, Joe.
Good afternoon.
And Matt Coleman, who is the president of Reinsurance at Demex, who provide a reinsurance solution for severe convective storms. So the way this is going to work today is Jake's going to give us a bit of an overview of how his company has been challenged by losses from severe convective storms, and an overview as to how they've looked at their reinsurance program. Joe's going to help us hear about ratings and how losses and combined ratios impact on ratings, and also how different types of reinsurance might be credited for a rating. And then Matt's going to chat a little bit more about what we're seeing in the market at the moment with some of the indemnity programs, how there may be some opportunities to optimize the program even more for 2026. And we will finish up with a Q&A. So if you have any questions, there should be a Q&A button for you guys to put them into. So put them in there, and we will look to get them at the end. So without further ado, I'd like to introduce Jake, and can't wait to hear what you've got to say, Jake.
Yeah, thanks, Nick. Appreciate the chance to be with you and share some thoughts here. Just a real overview from us, as Nick said. We're fresh to the whole parametrics view and how we assess that risk and build it into our reinsurance towers and program across the board. CFM is a Missouri-only mutual confined by the state lines of Missouri, and then we have a handful of other mutuals that are very similar to that confinement, that are all Midwest driven. As we all know, the weather's been crazy the past few years, and I feel like you can't hide from it no matter where it goes. Where it used to go from county line to county line, now goes from the Canadian border to the Gulf of Mexico. So it's really taking a step back to figure out how we best maximize that reinsurance spend, which for all companies is one of the largest expenses that we have on our books, to aid us in a good year, an active year, a unrealistically active year, to go forth with the traditional reinsurance program. So we're in our second year with Demex on a parametric cover. We learned a lot on the first year. And as I said on the last call, the most valuable time that we spent was really drilling down to the model of risk, where it is, how it works, what the weather patterns are, concentrations that we had a very good idea about. But no doubt in my mind, we understood that model so much better in our book of business, so much better as we went through that process. So as we turn the quarter here in year two, we understand how it works far better than we did from the start. We understand how it goes into our traditional reinsurance stack going forward. And we have a year under our belt to see how the weather patterns, which were consistent, they didn't subside, they were consistent, and how that helped our reinsurance program going forward. It allowed us in the 26 renewals to take a view of retention levels with our traditional reinsurance stack and how can we best implement the parametrics model into that to maybe lessen some of that retention or make it a little bit more predictable in the event that we have weather. Versus indemnity, you wait for the claims to come in, you wait to see what it costs. Um, with the parametrics, you have a really good idea as it happens as to where you are and where your concentration is. So, very important part for us to just better understand that whole program and maximize that spend to the best interest of our book going forward. We did have some nice recoveries in year one. They were predictable and constant, which was a breath of fresh air for me in a world of uncertainty with weather as it goes forward. We didn't see the severity as far as, major cat events like we saw in 22 and 23, but we saw again consistency. The frequency continued across the board as we went. And realigning that with our own model was very helpful. So our first year out of the chute, I would say the program was very valuable to the companies across the board. And hopefully we'll go forward with that to be able to build into our normal or traditional, I should say, cat towers and aggregate view as we go forward. So really, really looking forward to that in 26.
Hi. Thanks a lot, Jake. And we can dig into Jake's experiences a little bit more in the questions that anyone has at the end. So, Joe, really interested in your insights.
Well, I think we'll talk a lot about the reinsurance and we'll talk about ratings, but I think one thing that's important for both a review of parametric reinsurance versus other reinsurance is there was a 19th century philosopher by the name of Arthur Schopenhauer, and he talked about all three truths passing through three stages. First, it's ridiculed. Second, it's violently opposed. And third, everybody says, oh yeah, I knew that. And I think that when we look at whether it's any sort of discussion that brings in new ideas, I think we have to be aware of Mr. Schopenhauer's three stages. So we're a firm believer that it's here and it's time. But not everybody moves as quickly as the expert. So we'll talk a little bit about ratings. And I will say even there, when we look at the volatility of earnings, the volatility of operating results in general, whether it's impacted through a single large claim and event or whether it's a catastrophe, I think Demotech's a little different than some of the other rating agencies in that we believe that insurance companies are going to have a bad quarter, a bad half. You're the ones absorbing all the risk. You're the ones taking that on so that everyone else can sleep at night. So we don't see the impetus and for a year over year, quarter over quarter. I think we want to talk about reality as opposed to theory, and that's why I think that managing those earnings to the extent that you can is an important thing. But at the same time, there is a cost. As Jake said, reinsurance is the more than likely for the regional or the mutual carrier, particularly in the Midwest or in a cat-prone area, it is going to be your largest single cost. And there is a point in time where, that cost gets too precious. But we do believe that reinsurance is a critical component, and it's an important component in the sense that it provides smaller companies with the ability to run with the big dogs. And that reinsurance capacity is critical. And where it comes from, I think today is, and when I say where it comes from, whether it's parametric or other reinsurance, I think we've reached that point where the importance of reinsurance, the critical nuances between parametric and other reinsurance is that equation has been met and been solved. And I think that when you look at parametric insurance, there's a few things. People used to worry about basis risk. Is it going to cover the spread like traditional or dollar for dollar reinsurance would? And I think the important thing is that it not only covers that spread, but you're saving time, which is at the end of the day, especially in a catastrophe-prone area, whether it's a severe convective storm, tornado, a windstorm, or whether it's a hurricane that's taken days and weeks to form. At the end of the day, you got to rebuild. And the sooner you can get money to people, the better off everyone is. And the reality is, the sooner you settle claims, I think every claims person in the world will tell you, all things considered, the sooner you can settle, the better off you are in terms of a lower claims amount and less friction. So I think from my perspective, we're looking at the reinsurance as a critical component, but we're also looking at the ability to respond quickly. And we are no longer, I think, the industry should no longer be in a position where it's worried about basis risk, because lower loss adjustment expenses on parametric, quicker claims payments to consumers, all those things also have a role in the settlement of claims. And I'll be glad to hit some of these points later, Nick, when we're in the Q&A.
Okay, thanks a lot, Joe. Yeah, don't forget that probably at the bottom of your screen there's a little Q&A button which you can add some questions to. Matt, do you want to tell us a little bit about what you've seen in the market and how the different options that you're seeing are stacking up?
Absolutely. Thanks, Nick, Jake, and Joe. I'm happy to start just by providing some context on kind of where we've been and where we are, particularly with respect to reinsurance for frequency type perils. As many are aware, there was a massive reset in the reinsurance market about 3 years ago when retentions on reinsurance programs increased by as much as 5 to 10 times for certain carriers. And effectively what this did was it pushed the exposure to higher frequency, lower severity perils back across the table from reinsurers to those primary carriers. When we took a step back, looking at some kind of high level market numbers, I mean, we estimate that the amount of this frequency loss was on the order of multiple tens of billions to as much as 100 billions of dollars of potential loss annually. And today, 3 years later, retentions generally continue to be relatively higher than where they've been historically. And so what that's meant is that reinsurance availability for working layer type coverages, especially for regional and mutual carriers, has been extremely low. We haven't seen this full-on return of covering all natural perils or truly ground up aggregate covers being transacted at the scale that they were 4 or 5+ years ago. And what we've learned and what our different partners in the market have helped us understand is that historically this has arisen due in part to the basis risk that has existed between catastrophe model loss projections at these lower return periods in particular, and the actual loss experience that has been observed. And so we've seen that a number of largely socioeconomic factors, rather than any significant trend on a year-to-year basis in SCS weather activity, severe convective storm weather activity. These socioeconomic factors have really been the primary cause of some of these lower skill projections at these lower return periods. Things like exposure management, claims handling, inflation, amongst other factors like those. And when we look at what's going on today, it's still pretty rare that we see aggregate indemnity reinsurance being transacted. When we do see these types of indemnity-based transactions occurring and executing, we find that they're still not fully addressing kind of the death by 1,000 cuts that can result from these more frequent, less severe perils like severe convective storms. In the instances that are somewhat rare, when they do transact, these products can be relatively expensive 50, 60% rate online, almost dollar trading at some of the levels where these indemnity aggregates, have transacted in recent years. We have seen some highly structured, what are, qualifying event aggregate covers, QEA covers on the indemnity side that have been transacting. We've seen and heard about, a small number of these transactions in the most recent renewals here in 2026. And what that effectively means, though, is that there are still relatively high event level retentions on these products before a carrier can start accruing loss toward their annual aggregate retention. And so as we think about kind of more of where we are in the current market dynamics, coming out of these Jan 1 renewals, we've seen a number of carriers pocketing savings on their reinsurance programs this year, due to pricing reductions predominantly on their higher return period severity covers. Of course, the amount of savings depends on the loss experience of the cedent and their ongoing relationship with their reinsurance panel. What's interesting has been as Q1 has continued, we've also seen some carriers who are looking for ways to deploy these savings to actually buy protection for the working layer if they can find it. And this is where, with my personal experience of 20 years of underwriting in the parametric market, we've come to see and realize in these recent years that the parametric market, just like it's been doing for over a quarter of a century, continues to be well placed to address these lower return period frequency perils. We find that coverage is available at scale. It's available at prices that are a fraction of those that are currently rarely available for indemnity aggregate covers. And, as an example, during the past few weeks, we've had carriers coming to Demex wanting to learn more about, our modeled loss product that settles based upon the accumulation of modeled loss rather than indemnity loss. And it does so for severe convective storms on a ground up basis. One of these carriers actually ended up doubling its order when it was trying to fill the holes in its indemnity reinsurance program after they reviewed the relatively lower retentions and lower price that they could achieve with a modeled loss product. And so, as we are, seeing this pricing, be competitive and within transactable ranges, it's due largely to the trust that both, the carrier, the buyer of the protection, and also the reinsurer on the other side of the transaction, the confidence that they have in, a well-calibrated modeled loss index, being a good approximation of, a cedent's specific claims data. And when we look at those two parties of the transaction, we find that carriers, they are highly valuing the ability to leverage their own detailed experiential loss data and exposure data in order to calibrate the loss distribution and view of risk that's ultimately priced by these reinsurers. And on the reinsurer side of the transaction, we find that they value a modeled loss index because it allows them to access a purely weather-driven index, giving them that natural peril volatility that they're after, while also reducing the loss cost uncertainty that can be injected into some of the indemnity aggregate products due to those socioeconomic factors that we mentioned earlier. And it's been really exciting to see a number of these carriers continuing to look at, different forms of protection that they could put in place that start on February 1st or March 1st, April 1st, before the severe convective storm season starts in earnest. So yeah, it's been really interesting to see this convergence of, this existing parametric market that's well suited to address frequency perils and really be a well-positioned type of solution to address this frequency problem that's held by so many carriers.
Thanks a lot, Matt. And I think you touched on it briefly, but in terms of timing, everyone typically says, talks about the reinsurance all all renewing on Jan 1, but it sounds like you're finding that there's still scope both for people coming to speak to you, but also with you being able to offer solutions for 2026, you know, now and maybe a little bit going forward. Is that right?
Yeah, that's right. I mean, a number we see the traditional kind of renewal periods depending upon the financial calendars of different carriers. Many cedents coming on January 1st, looking for an annual cover. Others have programs incepting April 1st or June or July to, perhaps coincide with the hurricane season. And what's been really cool is, the atomic level of a modeled loss index. You can aggregate that up and choose and slice and dice whichever multi-month, 6-month, 12-month period that a cedent's looking for to align with their reinsurance program.
Right. Very interesting and useful if we're talking about trying to optimize reinsurance programs. We have got a few questions that have come in. Joe, I wanted to just ask you first about how do you generally kind of go about accounting for earnings volatility when you're looking at the rating?
There's a couple of things. I mean, the first is that there's seasonality in most companies' earnings, particularly if you're wind exposed or severe convective storm exposed. So part of it is if people don't get complacent if there's a season with no storms. So I think we look at those as the favorable aberration as opposed to the unfavorable one. So I think when we're looking at earnings, we're not really looking to stabilize earnings over an extended period of time. We're really looking at earnings on a bespoke basis. The curve for the company is the curve based on where they're located, what lines of business they write. We're not looking at it in an abstract basis. I think from a collections, if you will, or a funding perspective, I think one of the things that we see is with the loss portfolio being your own loss portfolio under a parametric, you're now 100% responsible for your book of business, but you've laid off the part related to severe convective storms or weather. So I think it's important for us when we're looking at a company's portfolio and their loss experience. We also are looking a little deeper at the type of information that they're analyzing to come up with their underwriting decisions and to come up with their reinsurance decisions. So at the end of the day, what we're really looking for is for the company to commit to optimizing the data that it can share with the modeling firms. And at the end of the day, that data quality is also going to assist you understand why your results are better or worse than the competition, better or worse than last year. So it's a integral process where everything is interrelated. And that's one of the things that I like about the concept of parametric reinsurance is at the end of the day, it's your book of business. You can't do anything about weather, but you can do something about the quality of your data and the quality of your book.
Thanks, Joe. I think that's interesting, just going back to what Jake was saying earlier in terms of over the last year or so, they've got a much better understanding of their own data through going through some of the reinsurance process and how that looks and how it helps the decision-making process. Jake, probably a couple of questions for you. One, just in terms of you bought a SCS reinsurance product last year and you've renewed it this year. How different has it been in terms of the evaluation process of the initial purchase versus the renewal? But then, secondly, a question that we've got around: are parametric solutions filling the gaps in traditional reinsurance programs, or are they mostly additive protection?
Yeah, that's a great concept with both. I think, anybody that's associated with a company would agree that there's you can't understand your book of business well enough, right? And I think we're all on this journey of how do we truly know what our risk exposure is in a market that, to my knowledge, is the only market that we price the cost of goods sold before they know what they cost from year to year, right? That's tough. And so as you drill down on data that so many of us have great systems, great technology that's been a part of this is I think the old concept of having it, now they have it. It's kind of like the dog that caught the car is how do we analyze it? Like how do we drill down to understand what we have and what it means and the possibilities thereof and how it impacts our balance sheet at the end of the day. And through the modeling process, I think you get a much better understanding of that. But then you also see the underwriting opportunities, market growth opportunities that come with it in the areas that you may not have that type of exposure. And I think, my constant goal going forward and has been for some time is I call it fingerprint rating, which is not my term, but each risk is so specialized, whether it's a home, a farm, a commercial exposure, an automobile, like what is the likelihood of loss when you write that piece of business? And then it goes further of wouldn't it be cool if you could know what reinsurance cost on a new piece of business or renewal at the time that you issue that new effective date? Like when you drill right down, like what is this guy going to cost me in a worst case scenario, likelihood of loss scenario, and it's never going to happen scenario. So we can apply that risk in the rate in real time so we know right then and there the profitability side potential as we go forward. And I think, that's one thing that we're not there yet, but I think technology will get us there with the modeling and data that we have at hand. But more so with a mutual hat on is, you know, and Matt, you said it. I love this conversation because people that don't know parametrics and modeling, like they think it's a brand new thing. Like it just woke up yesterday. It's been around for a long time, right? It's been around for a long, long time. I think you said 20 years of underwriting history, if I heard that right. That's just 20 years. It was around before then. It is, this is a cool way with my mutual hat on to rethink the way that we have bought traditional programs for most companies that are 100 plus years old that are out there. Not all of them, but most of them. And that mindset has been what has made that company successful over a period of time is how do we adapt what used to be normal into the new normal? And then more importantly with that is how do we take the data that coincides with the modeling to most effectively maximize our return potential if a bad case happens or death by 1,000 cuts happens, because we just don't know, right? So I think that's a very important part of this is it better helps you in summary, better helps you maximize the data that you have and not just have it, but how do I use it? How do I make something of it, right?
Thanks, Jake. And that probably shifts quite nicely onto the. I've got a couple of parametric questions, probably Matt, certainly to start with. And Joe touched on this earlier. I mean, people talk about basis risk as if it's a purely parametric issue, which I know it's not. But if you could just kind of go through a little bit of the basis risk kind of conversation. And then also got another question around how the parametric insurance works for hail events and hurricanes. So you might want to detach those or kind of work them together a little bit.
Mm-hmm. Yeah. It's a question that comes up very frequently, often in the context of kind of the output side of things. So if I have some index-based trigger, if it's a weather trigger or a footprint trigger or modeled loss trigger, the conversation's often about how does that trigger and payouts from it, mirror or not my actual indemnity losses. For our product, the short story is we found that our modeled loss index for severe convective storms on average is typically within 5 to 10% of indemnity losses. And we found that index tracks very well with SCS weather activity that occurs across a carrier's, exposure footprint. But when thinking about this topic overall, there's a lot of nuance, which I think we're starting to unpack here. It's not only kind of that output side, there's also the input side. And what's been really interesting is kind of contextualizing this this idea of basis risk for parametric products and kind of zooming out to a higher elevation to look at basis risk and where else it can manifest itself. Everything from claims handling and inflation. On that input side, we've come to learn and respect that, the utilization of traditional catastrophe models, they can have very different estimates of return period losses that are ultimately then used to define the attachment points of reinsurance programs. On that point, we learned that a regional carrier, customer of ours, had one catastrophe model for its 1 in 100 loss being 60% higher than what another catastrophe model said for that same return period. And the solution, sometimes is as simple as, taking those two return period estimates and dividing them by 2 to set the attachment point of a program. And so on that input side, there can, basis risk can manifest itself before you even start talking about, a quote parametric product and how that augments, the overall amount of basis risk in a program, before you even get to that conversation. And so, what we've found is that it's really helpful to think about basis risk on a spectrum, where on one end you have, indemnity-based products that we all know and have come to appreciate. The basis risk with those, as we're discussing, is non-zero. But you have that on one end of the spectrum. You have pure kind of index-based triggers on the other end of the spectrum. It might be, a wind speed trigger or, a temperature trigger or something like that. And then in the middle, you have some other forms of kind of hybrid parametric type products like industry loss warranties. When we think of our solution, we kind of think of it somewhere between a pure indemnity product and an industry loss warranty, because ultimately it's, again, this cedent specific calibrated modeled loss vulnerability curve that is effectively, a cedent calibrated loss index. So that puts us closer to that indemnity end of the spectrum. But that's what we found as kind of a way to contextualize overall the different types of triggers, indemnity, parametric, or otherwise, that could be used in reinsurance programs.
The basis risk issue, which was, I think, fairly well explained. Basically, if the cat treaties of that we're used to are going to pay $1 and you only get 97 cents, you got 3% risk. But there's also the possibility that you go get more than your modeled losses. So I think between that possibility, between the shorter payment times, less loss adjustment expense, and the other issues, that the basis risk issue discounts those other advantages and maybe even ignores them more than discounting them. But that being said, the other place where I think that this becomes very helpful is the audience would not believe the number of carriers, whether they report to the NAIC in the traditional form or their state reporting companies, the number of carriers with less than $1 million of premium. And for that particular carrier, it has to know its book of business. It has to have these sorts of estimates and time, not just timely, but accurate. And when there's literally companies that we have seen, we don't rate them, but there's companies out there with less than $100,000 of premium. I mean, what is it that they're going to do? And so there has to be alternatives. There has to be accuracy of information. And at some point in time, the concept and there's no difficulty for these smaller companies, they need something. And the concept of basis risk, I think, is really out the window because the base of itself, BASE, is so small that they need something. And there's a lot of companies that won't even talk to a company with that kind of dollar volume. They can't get reinsurance. So anyway, those are some of the things that I think we have to be cognizant of. Rather than criticizing something because we're unfamiliar with it, I think we need to become more comfortable and to understand that one or two revisions to a more popular in terms of frequency, in terms of the cat reinsurance, I don't think that we stop. We have to keep moving forward. We have to keep developing new ideas, and we have to keep refining them. And data and cat modeling and self-testing and going back, those are all the ways we get there.
Thanks, Joe. I think that's quite a nice summary. If anyone does have some more questions, feel free to pop them into the Q&A. I don't know whether Jake or Matt, you've got any final kind of closing comments you want to make? Okay.
Matt, I'm going to let you put a bow on it because you're much better than I am at that. But I think just to reiterate a few things there that Matt mentioned and Joe mentioned is, Joe, I would go further out to say, 100,000, the definition of small has changed so much of late, right? I mean, I feel like the big of yesterday is now the small of today, right? And that scale and economies of scale for a 50, 60, $80 million rider is just as tight 9 times out of 10 as a $5 million rider, right? And so how do we effectively as an industry use new, innovative, or not new, innovative, but products that are available to complement our existing stack is so important going forward. And this is a great product to be able to do that. Matt, you mentioned that final thing there is like what I love is about Demex and this type of model is have the conversation and ask. Like, what if we did this? Or what about we did that? So hail's my risk, wind's my risk, whatever the risk is, can we model and develop a product for that takes some pressure off the traditional towers and silos and programs to where we can sleep better at night for something that we literally have no idea what's coming tomorrow, right? And I think as we continue to do that with the companies going forward with products like Parametric, it only complements, it helps. And then it takes another step, which is a whole webinar in itself of educating those, and Joe mentioned that on that are making the rules, that this is an okay thing. This is a good thing. It's positive, and it's not a scary type of, concept that has never existed before, because that's just simply not true. It's here, it's helpful, it's good, but you don't know until you ask. You don't know till you have the conversation. So I would encourage that for everybody to do exactly that.
Yeah, and just building on that, I mean, it's been so exciting to see that regardless of size of carrier, there's just more and more data available that these carriers have. In the instances when maybe they have a shorter duration, a time series of those data, or maybe it's more sparse. We found that taking a collaborative approach with the carrier, with their broker, to help fill in those gaps with some industry type data that we've been able to aggregate, it can go a long way. And then you take, that's one side of it. You take the data and the analytics and being able to overlay that with relationships, with different partnerships, understanding where programs already sit, how they've evolved over time, and how can we help be the grains of sand that fill in between those marbles that are in that jar. And I think that's been really exciting to just look at this overall ecosystem, relationships, data, and finding new ways to solve problems.
I think it's been really interesting listening to everyone today. Thanks very much for your time. Clearly, the need to understand your data helps everything, as does knowing what's out there. So when you're looking at reinsurance protection across the whole business, what options are out there, and being able to evaluate them from a strength of familiarity rather than I've never heard of that before, so I'm not going to evaluate it. I think it is really important. I also know that if anyone is interested in a severe convective storm market assessment for their book of business, that there is still time to look at that for Demex. And if you'd like to do that, then just hop on the Demex website, the demexgroup.com, and fill in the contact us page, and we'll get back to you and speak to you about that, because the season hasn't started yet, and we're all kind of hoping for a less volatile season, but you only have to look at the last few years, and SCS losses are just right up there every single year. So thanks again. Thanks very much for your time. Thank you, to the panelists, and yeah, have a great rest of the day.